Something we're getting a lot of, the IRS took all of the money out of the bank and they put a lien on my home and they want to look at all my assets. Can they do that? I haven't filed for over 10 years and had no idea they had so much information on my income. What should I do? Boy, that's a tough question.
Yeah, this question actually alludes to a few different issues. One is this is a non-filer for 10 years. So this person needs to go out and get their returns filed. And the way they need to do that is they need to order their record of account and income transcript from the IRS. With those documents, they can prepare the returns to some extent, and at least it'll look consistent with what the IRS is expecting to see. On the income transcript, once they get that from the IRS, that's a record of the taxpayer's 1099 and W-2 income, as well as their mortgage information if they have a house as well. The record of account will show the taxpayer, which they also receive from the IRS. The record of account will show the taxpayer what years need to be filed and what credits they have for each year. Also, what's happened here is that since this taxpayer has been a non-filer for 10 years, the IRS has gone ahead and assessed a tax against this taxpayer. And that occurred one of two ways. The first way that could have occurred is that the IRS could have prepared returns for this taxpayer on their behalf. That is called an SFR. It stands for Substitute for Return. Since there's not a return on file, the IRS, under Internal Revenue Code Section 6020B, can prepare returns for the taxpayer. And then the IRS calls these returns SFRs. The other way the IRS could have assessed the tax liability is by doing an audit on the taxpayer without the taxpayer actually even being in there. That audit occurs internally, and what the IRS will do is the IRS will summons the taxpayer's bank records, because they have those records. They summons the bank records, and they'll prepare a return based upon what they see as far as income running through the taxpayer's bank account. Once the tax is assessed, the IRS can then go ahead. The case gets moved out of assessment or pre-assessment division into the collection division. Once the tax is in the collection division, then the collectors at the IRS will go out and levy bank accounts, levy wages, and pursue the tax. So this taxpayer needs to lower their tax liability by filing the missing returns and simultaneously deal with the collection division to stop the collection activity. And when the IRS levies a bank account, what taxpayers really need to know is that that levy only applies at the moment in time the levy is received by the bank. So if the taxpayer has, let's say, $500 in their bank account, that levy will attach that $500. If the taxpayer puts another $1,000 in their bank account after the levy is received by the bank from the IRS, that $1,000 is available for the taxpayer to use to pay their bills. The initial $500 that was levied by the IRS will be held by the bank for 21 days, which gives the taxpayer time to negotiate with the IRS and tell the IRS they need this money to cover necessary living expenses. And if they can prove that to the IRS will go ahead and release that $500, and then they'll have access both to the $500 that was levied by the IRS plus the subsequent $1,000 that was put in to help cover the additional personal living expenses.
You know, questions we get from viewers, they assume, or folks assume, that the IRS filed a lien. I'm doomed. There's nothing I can do. I'll never have any money again. I'm going to starve. I may as well leave the country. But that's not really the thing you want to do.
Absolutely not. And that reminds me of a case where a taxpayer who had a wife and a brand new baby was in almost this identical circumstance and took off to New Zealand to sell vacuum cleaners. Believe it, it was kind of an odd decision. But nonetheless, leaving the country only makes the problem worse, because when a taxpayer puts himself beyond the collection and assessment abilities of the IRS, the statute of limitations, the period of time in which the IRS can collect the tax or assess the tax, gets dragged out during the period of time the taxpayer is unavailable to the IRS or out of the country. And also, that's no way to fix a tax problem. I mean, obviously the best way to fix this kind of problem, and also for the gentleman who took off to New Zealand, is to go back, file the missing returns, address the collection issues, and resolve the tax liability. And the liability can be solved in a variety of ways. I mean, the taxpayers can go on installment arrangements. They can do offers and compromises, which are settlements. They can go on hardship status. The IRS has a lot of different rules that are contained in the Internal Revenue Manual that allow taxpayers to resolve their tax issues.
And Sam, let's get into that offer and compromise a bit, because I know that's presented by a lot of companies as, oh, the offer and compromise, everything is rosy, it's all done, your tax liability goes away. There's a tad more to it than that.
Yeah, absolutely. The IRS processes about 45 or 50,000 offers and compromises a year, which is a very, very small portion of the amount of people who have tax problems. There's probably 17 to 20 million people out there who have a tax problem, and only 50,000 offers and compromises are being submitted. To make an offer and compromise work, the taxpayer has to make their financial circumstances fit an IRS equation or an IRS algorithm. And the IRS equation is basically this. The IRS will settle any amount of tax liability if the taxpayer can show that they're living paycheck to paycheck, they have very little equity in assets, and that their necessary living expenses are reasonable. You can't go out and live in a mansion and drive a Rolls Royce and say to the IRS, hey, look, I'm barely surviving, because you're not surviving at what the IRS considers to be a reasonable level. But if you are surviving at a reasonable level, then the IRS is more than willing to settle the case. There's no issue about that. And what's unfortunately happening in this industry is that a lot of taxpayers are submitting unqualified offer and compromises, so a lot of them are getting rejected. The IRS is only accepting about 25% of all offers that are submitted as a general population.